Today, let's explore how rate cut accelerate wealth inequality and how we can leverage capital and knowledge to position yourself to play the same game. The wealthy do. Russell 2000 is the US small cap stock index made up of about 2,000 of the smallest publicly traded companies in the Russell 2000, the businesses that are more sensitive to interest rates, liquidity, and the real economy. As we can see, the Russell is setting up for an imminent breakout to all-time highs. This is on the back of the Fed rate cut and is hurling the market toward an unsustainable melt-up. This will set the stage for larger risk assets, like crypto reacts the same way. Rate hikes kill speculation, rate cuts revive it. Real rates is interest rates after subtracting inflation, which is falling. Money is getting cheaper in real terms. At the same time, the economy is still growing. That means dollars keep flowing, companies keep earning, and people keep spending. When that happens, liquidity expands, and all that cash needs somewhere to go. Safe assets don't pay, so it floods into risk. Small stocks, altcoins, anything high beta. That's why the Russell 2000 and crypto have been going up. It's not random, and it's directly tied to the collapse in real yields. We always say market is random, but on the other spectrum, nothing is random. Remember, falling real rates plus positive growth equals liquidity goes towards risk assets. But the difference today for 2025 is we're starting from a much higher base of interest rates. Risk assets like crypto can still climb toward those old valuation peaks, but the higher it goes, the thinner the air gets. This kind of rally carries the cause of its own crash. It shoots up fast, but it's fragile and can break just as quickly on the way down. So the entire question everyone wants to know is, when will this melt up end and how high can we go? I think investors with a little bit of brain know the upside does not go forever, how EVR. Just know we can possibly go much, much higher before we go lower. There are three major signals we need to watch in order to map when the melt up is losing strength and when moving to cash is the play. The signals are listed in our private community, so we can always stay tuned. If we pull all of these moving parts together, the implication is clear: the melt up is still on. Risk assets remain skewed to the upside, but the risks are building because the policy error by the Fed is sowing the seeds for a future crash. But how does this affect wealth inequality? In 2025, the world's richest 1% gained over $33.9 trillion in wealth since 2015, enough to end global poverty more than 22 times. How can we be on the side where wealth is growing, not shrinking? Since 2008, over 70% of US wealth creation came from asset appreciation, not wages. If you weren't positioned in stocks or crypto, you missed the compounding. The bottom 50% of households hold less than 2% of financial assets. That means most people are locked out of the very game where wealth is multiplying. This is why the gap keeps widening. And it's crucial to learn how to use leverage of knowledge, capital, and community to ride these liquidity cycles instead of being crushed by the system. It's not just money, it's the level of cognition and the perspective of the world instead of our own perception. If you want to close that gap, you can't just hustle harder. You need to upgrade your cognition system. You need to see reality as it is, not as the crowd perceives it. The wealthy see reality differently and create their own visions. To close that gap, you need more than effort and money. You need to let go of your outdated mental buildup.